Hi, this is Optimus Futures, and we're back with our weekly roundup of key futures markets for our viewers. For this week, we'll be analyzing the five markets that we do for the week ended May 25th, 2018. And before we begin looking at the technical aspects of the five key markets, we're just going to like to quickly mention a very important fundamental development that happened last week that had an impact across pretty much all of the five markets that we analyze, and that is that the country's president, Donald Trump, basically pulled out of the Korean summit, stoking tensions once again between the two countries, leading to a positive influence in haven assets like the 10-year Treasury note futures market and the gold commodity futures market. It also had a negative impact on the crude oil market and the S&P 500 market. As you can see over here, the S&P 500 E-mini futures market really didn't move much at all, pretty much the entire week, despite basically breaking out of a very profound and obvious wedge pattern formation over here. If you recall from our analysis last week for this market, we've been talking about how the market basically broke out of this descending resistance trend line, forming part of the wedge pattern over here, and really didn't pull back to it to test it as support before taking off. So we didn't have a textbook breakout pullback continuation play that usually technical traders are looking for. Instead, we just had a hold up slightly above the 2700 round number, and of course this minor swing high over here. And last week we just continued on with the same theme. We really didn't have a lot of interest from traders, partly due to the fundamental development that we just talked about, and partly because the market here may possibly be looking to at least pull back and test this trend line over here for potential indications of support before continuing on. We also said last week that this could also be the development or the foundations for a more prolonged sideways market action that really wouldn't be reminiscent of a typical breakout play that a lot of traders might be expecting here. Because like we said, this lack of trading activity here definitely doesn't make for a very good, strong breakout story just yet. So either the market here is going to try to pull back to this trend line and then continue up north, or we could see more prolonged consolidation depending on how the overall macroeconomic and fundamental platforms shape up for this market, and and how price basically behaves or continues to behave above the 2700 level and this former swing high over here. Okay, so the next market we're going to be looking at here is the light crude oil futures market. Of course, another market that was negatively affected by the fundamental development that we just talked about. For this market, we've been basically eyeing the 7500 level as a very important long-term level for this market, and also a very significant and valid potential area of resistance for this uptrend that we've seen this market pose for the past several months. So if you plot the 7500 level around here, it basically lines up with some of the very, very important swing lows that this market witnessed way back in 2011 and 2012. And just looking at the formidable support that we've had at this price level way back in the past, we were expecting the market to possibly rise up to this level and find some major resistance. So the move that we witnessed last week, we were kind of expecting to see that at the 7500 level, although of course the market really didn't push up to that point, at least for now, and we're seeing a major pullback, a major correction into the uptrend over here. So if we zoom back into the more recent price action on the daily time frame for this market, we can see that the 6600 level that formerly held as major resistance for this market and eventually gave way for the uptrend to continue as the market pulled back, found support, and then continued up. You can see that the market is now perilously close once again towards this level, and we suspect that this level over here, the 6600 level, will definitely have a very important role to play here in determining the fate of this more longer term uptrend that we've seen for this market. So if we do not really hold as support at the level, and if the macroeconomic geopolitical tensions continue to jeopardize the prospects of this uptrend over here, we may see the market sort of pull underneath the 6600 level and we could either end up being in a more elongated consolidation phase over here, or maybe even an extended pullback, or maybe even a short-term downtrend for this market. On the other hand, if the 6600 level continues to hold a support and allows price to basically resume the uptrend, we could see the market then pushing up towards the 7500 level that we've been interested in for this market to see in the coming weeks. So a lot will really just depend on how the 6600 level here behaves and whether it provides support for this uptrend or not. Okay, so the next market we're going to be looking at here is the Euro currency futures market, which against all odds just continues to make its move down. And when we say against all odds, we basically mean that the market, as it pushed down, when it broke through this wedge pattern over here, we had identified that the market will likely face a lot of trouble and a lot of hurdles from all these former horizontal areas of support and resistance formed by this former consolidation box over here. But really, the market really hasn't been able to find any kind of formidable support at either of these levels. Last week, we had identified this this lower level over here as a potential cause of the market rebounding and finding support just above the 1.16 level. But once again, that too hasn't really happened at all. As you can see on Friday, we once again closed very bearish, making a new multi-month low for this market. And now, as this market stands right now, we're basically sitting pretty much at this very important swing low. If we actually zoom the chart out a little bit and scroll back, we can see that this is not only an area of support, but also an area of very important and significant resistance that we witnessed off the 1.16 level in the past. So if we stretch this level, you can see that not only do we have formidable support here at 1.16, we've also had a very important touch on the level from the underside where the market basically found a lot of resistance at this level. So now that the market is basically eyeing to hit the 1.16 level, it should make up for a very interesting case, because we've seen so far that the market has been able to penetrate rather smoothly and with a very stable momentum here. It's been able to push through all of these former areas over here. Now that we're basically very close to a more longer term, more significant horizontal support and resistance level, it should be interesting to see if the market's going to basically hold here, or we'll just continue to see the market push down and create more momentum into the sell side pressure that we're seeing here. Notably though, for quite a while now, we really haven't seen any kind of a pullback at all. We really just saw a very minor one just about over here as the market pulled back to the 1.2 big round number. After initially breaking underneath it, it pulled back, held as resistance, and continued on with the major sell side pressure that we're seeing for this market. So we really haven't seen any kind of a major pullback into this down move so far, and which makes us think that we're possibly due for a pullback here as well. And that pullback may actually be coming in at the 1.16 level, given that it's such an important and long-term horizontal support and resistance level for this market. But overall, the sell side pressure here definitely has impressed us, and against all odds, like we said, at least from a technical perspective, this market just continues to push past former important horizontal support and resistance levels. So for this week, it'll be interesting to see what the market does as it basically hits the 1.16 horizontal support and resistance level. Okay, so the next market we're going to be looking at here is the gold commodity futures market, which of course responded positively to Trump's pulling out of the Korea summit. Of course, being a safe haven asset that a lot of traders usually move towards when there's increased geopolitical or macroeconomic tensions in the country. But this uptick that we witnessed last week also makes up for an interesting technical analysis as well. So if you recall our analysis for this market in the last week, we had identified how the market clearly seemed to have broken underneath the 1300 level and all of this consolidation phase above, and we'd witnessed how we had a very strong day's trading activity towards the downside. We had a strong close in the candlestick as well that broke out of the 1300 level. All indications that the market had made a genuine effort in trying to break past the 1300 major round number support, And of course, for this market, we've been talking a lot about how it would stoke our interest if the market either broke underneath the 1300 level or had broken above the 1350 resistance level that has been acting as the ceiling for this more recent period of consolidation that the market has been in. So interestingly, even though we had witnessed this kind of a breakout underneath the 1300 level, we had identified how this entire area over here that had earlier been holding up price and making sure that it consolidated within the 1300 level and the 1350 resistance level basically extends into a more important longer term thickish horizontal support and resistance level. So as we draw this level over here, you can see that although this entire level here is definitely pivoted at the 1300 round number, it is actually a range of price levels here that are acting as support and resistance for the market. And we had identified how, despite the fact that the market had broken underneath the 1300 level, the following candlesticks really not showing a lot of bearish momentum at all here alarmed us into thinking that we may not have broken past this entire area of horizontal support and resistance level just yet. So even though a break underneath 1300 level spark our interest in the market, we had identified how we would be looking for some more profound sell side activity for this market to confirm that the market had definitely broken past this entire area of horizontal support and resistance. And as you can see, the fundamental development that we witnessed last week that allowed for buyers to come in also had a very strong technical reason for it. As you can clearly see that despite the strong bearish candlestick over here, the market hadn't really cleared this this more thickish area of horizontal support and resistance. And so the market, or we should say buyers coming in at the price levels that they did at the past week really shouldn't come off as a surprise, even as strictly a technical trader not very interested in the fundamental developments that basically took place in the last week. So as we move into this week, we suspect that a lot will have to do with price trying to either penetrate this former area of support over here, and if it does find legitimate resistance at this level, we could see it move back down, and maybe a more genuine attempt at trying to break past all of this, all of these tightly congested areas of horizontal support and resistance that we just identified. On the other hand, if we really do not hold as resistance at this level, the market could once again go back into this period of consolidation over here, and we could see another phase of the market just going sideways and being choppy. Okay, so finally we look at the 10-year Treasury note futures market, which of course being a haven asset as well, responded positively to the fundamental development last week. Like gold, however, if you look at this market strictly from a technical perspective, the move up that we witnessed last week can still be very well explained. If you recall our analysis for this market last week, we had identified how we continue to see the market in a very strong downtrend over here. We're continuously seeing lower lows and lower highs, which are typical of a downtrending market. We had still identified that the market seemed to be heading towards some very important and historical price levels. If you zoom out of the chart to look at the bird's eye view of where the market is at currently, you will clearly be able to see that the market was pretty much sitting at a very, very significant former area over here, where back in 2011 the market consolidated for a while before eventually springing into a very elongated and a very extended long-term uptrend right off of the current levels, which would pretty much line up with 118 and 119 areas over here. So just looking at the fact that the market was heading into all of these important areas, we had identified how a move up or a sharp bounce off either of those levels, the 118 or 119 or price levels in between, really shouldn't come off as a surprise at all for a technical trader. And so precisely the move up that we witnessed last week sort of happened just above the 118 level. We had identified the 118 level as more of the business area for buyers for sure, looking at just how it lined up with that consolidation box that the market witnessed at this price level back in 2011. As you can see, the market was kind of just shy off the level. We didn't really hit the 118 level precisely, but still, just looking at how we had more of a consolidation box and the surrounding price levels back in 2011 that eventually resulted in a very sharp uptrend. It really isn't an anomaly per se for the market to not exactly bounce off the 118 level. By no means saying that the bounce here could be reminiscent of the price action that we witnessed back in 2011 and 2012 that saw us post a very long-term uptrend. We're not saying that the market has completely rebounded and is going to be creating a major long-term correction back into the downtrend over here, but we're definitely saying that the bounce that we saw last week here can definitely be technically explained, and where we're bouncing off a region of support here, which also explains why the buying came in, besides the fundamental developments that triggered the buyers to enter the market. So as it stands right now, the market sort of closed at the 120 major round number that has had a very important role to play for this market in the past. Of course, when the market was heavily downtrending, this was also the level that had held price up for quite a while before eventually giving way, and the market pulled back to it, held as resistance, added perfectly before pulling back down to continue with the downtrend. Until, of course, we saw the move up over the past week, and now the market's pretty much sitting at the 120 round number, which we believe will continue to play a very important role for this market. So if we continue to find resistance at this level, there are chances that the market will probably rebound, and we could see newer lows for this market. On the other hand, if we do not do that, if price just continues to make a move past the 120 round number, following from the bullish activity and the bullish trend that we've seen last week, this level could then probably turn into support, and we could either see something like an inverse head and shoulder pattern develop over here, or who knows, maybe just a period of consolidation. Either ways, this just doesn't look very good for the downtrend unless price finds formidable resistance at the 120 round number.